Hello and welcome to the Baird Trust Equity Income Third Quarter Portfolio Recap. My name is John Watkins and I'm a co-portfolio manager on the strategy. Jumping right into performance, the table at the top of this slide shows our performance track record. In the quarter, our portfolio declined 5.1% gross of fees and 5.5% net of all fees compared to the 5.6% decline in the Russell 1000 value and the 4.9% decline in the S&P 500. And for the year-to-date period, our portfolio declined 21.1% gross and 21.9% net compared to the 17.8% decline in the Russell 1000 value and the 23.9% decline in the S&P 500. And then the bottom half of this slide shows the individual companies that were our top and bottom contributors for both the quarter and the year-to-date period. I'd like to highlight a few things here. First, you'll notice that over the year-to-date and one-year period, our equity income portfolio is lagging the Russell 1000 value, but outperforming the S&P 500. For many years leading up to this period, that relationship was flipped. There's one key factor that's driving the strong performance of the Russell 1000 value and our underperformance. The best performing sectors so far this year have been energy, utilities, and consumer staples. These sectors make up a larger proportion of the Russell 1000 value than they do of the S&P 500. And the substantial performance headwind we face is the fact that we have no holdings in the two best performers, energy and utilities. This negatively impacted our performance relative to the Russell 1000 value by 3 percentage points, which is essentially the entirety of our underperformance. We've previously noted that we have been unable to find any investment opportunities that meet our business, management, dividend, and price criteria in these sectors. That fact is a headwind to performance so far this year. As a reminder, our goal is to own the best businesses we can find for very long periods of time, not to try to figure out which sectors will be hot in any given year. So given today's stock declines, I think it's important to take a step back and remember that we have three objectives for this portfolio: attractive current dividend income, attractive dividend growth, and then a total return that's greater than the Russell 1000 value over full market cycles. So we place much more emphasis on our 5, 7, 10, and inception to date investment performance. Over each of these time periods, we've experienced significant uncertainty and volatility, several bear markets, a pandemic, stock market corrections, among many other scary events. Yet, even including this year's losses, our portfolio's gross and net performance has been outstanding over these long-term time periods. Finally, when looking at year-to-date individual company performance near the bottom of this slide, it can be jarring to see 30 to 45% price declines for some stocks in the portfolio. But as we've said before, we believe that stock prices are much more volatile than the fundamentals of the underlying business. A great example of this would be to highlight our largest negative contributor for the year, Home Depot, which is down 32% in 2022. However, in 2021, Home Depot saw a huge stock price increase, up 56%. And then the other four bottom contributors, which are all down substantially this year, similarly saw large stock price increases last year between 27 and 35%. So stock prices are driven by many more factors than simply business fundamentals. Last year, optimism reigned and pushed prices higher, and this year, pessimism has taken the place of optimism. Our view is that stock prices do not tell us much about what's happening with the business. For that, we look to things like revenue growth, margin expansion or contraction, earnings, and free cash flow changes. Stock price gyrations should not be used to inform you. Rather, they should be used to serve you when they create substantial mismatches between price and intrinsic value. Moving on, this slide shows our recent portfolio changes. We have not made any changes so far in 2022, but our research efforts remain highly active. Prices of companies on our watch list have come down substantially, so our efforts to find new investment opportunities continue daily. On the left-hand side of the slide is the list of the 7 portfolio holdings that increased their dividend payments in Q3. Third quarter is a relatively quiet one for dividend increases, but I would note that Charles Schwab actually increased its dividend for the second time this year. They raised their dividend 11% in February and then another 10% this quarter. And then the table on the right shows the dividend characteristics of our equity income portfolio compared to our benchmark, the Russell 1000 value, as well as the S&P 500. And as a reminder, 2 of the 3 portfolio objectives are to achieve a higher dividend yield and faster dividend growth than both of these indices. And as you can see in the table, as of September 30th, we are achieving these objectives over the long term. I would point out that the trailing 12-month dividend growth number is negatively impacted by T. Rowe Price's decision to pay a large special dividend last year, which was not continued this year, and that hurt that year-over-year comparability. However, our portfolio has a current yield as well as long-term dividend growth track record that is superior to that of both indices. Unlike many dividend managers, we believe dividend growth is critical to our long-term success, especially in today's world of elevated inflation. A stream of income that is growing rapidly is much more valuable than one that is growing slowly or staying flat. Finally, just a few big picture comments. This year has been a tough one for equity investors. Stocks are down. We're in a more prolonged bear market than we've seen in quite some time, and there are many macroeconomic issues to worry about. These fears are normal, but as we wrote in our October Baird Trust market commentary, our view is that the future is not knowable. The last 3 years serve really to emphasize this point, as much of what has transpired was not predicted by anyone. We use this belief as a starting point in our investment process. We build the portfolio with the knowledge that the future is unpredictable and that there will be many surprises, both negative and positive. Because of this, we try to partner with businesses and management teams that can endure whatever external environment's thrown at them. This means companies with strong competitive advantages, low levels of debt, and that generate lots of free cash flow. In fact, these are often the businesses that not only survive the tough times, but actually grow stronger through market and economic downturns as their weaker competitors struggle to survive. These companies emerge in a stronger position whenever the tough times subside and the next expansion begins. We know bear markets are difficult. Watching portfolio values decline is not enjoyable. However, bear markets are a common occurrence in the equity markets, and economic slowdowns and recessions are bound to happen from time to time. Importantly, with the stock price declines we've seen so far this year, our portfolio of companies now trades at a wider discount to our estimated intrinsic value than we've seen in many years. So while this tells us nothing about near-term stock price performance, it is our belief that for the long-term investor, large discounts to value often correlate to attractive future investment returns. History has shown that no bear market or economic contraction has lasted forever. While we don't believe anyone can consistently predict the exact timing, eventually a new bull market and a new economic expansion will begin. So that does it for the Q3 portfolio recap. We look forward to reporting our Q4 results to you in January. Thank you so much for your time.